Hey guys, today we're going to talk about TSLY ETF and how it actually gets a 76% distribution yield. So I actually think that TSLY uses a very simple option strategy, and for anybody that knows anything about options, they've probably heard of the option strategy that they use. However, I do think that many people think it's very complicated and therefore will just buy TSLY instead of doing it themselves. So in this video, what we're going to do is I'm going to explain what TSLY actually does so we can implement it not only on Tesla stock, but on every other stock we like. So let's get into the video. So essentially what TSLY does is it's a synthetic covered call strategy on Tesla stock, right? So that means it actually doesn't own any Tesla stock. It just uses options to replicate the performance of Tesla. So they say it's a Tesla stock ETF, however, it's a Tesla options ETF. Essentially, this ETF has three parts. So one is they create a synthetic long position. Then they create a synthetic covered call, and then they buy treasuries. So let's first talk about why they use treasuries, because it seems like every derivative ETF actually buys treasuries. So the reason why they use treasuries is because it's the best investment, the best security to use for collateral. So you want something that's stable, that also generates a small yield. That's when you buy treasuries. So that's why many derivative ETFs actually buy treasuries and not just buy stock or keep it in cash, because treasuries are something that's predictable, and TSLY actually buys short-term treasuries. Then the synthetic long position. So what they do is they sell an at-the-money put option and buy an at-the-money call option. The money that they receive for a premium when selling the put is what they use to buy the call. And because they're both at the money, which means it's what it's currently trading at. So for example, an at the money put for Tesla would be about $280, and then you buy a $280 call option. So then you've created a synthetic long position that essentially replicates the performance of Tesla stock. So then they sell a covered call on top of it. So because it's a synthetic long position and you sell a covered call against it, it's called a synthetic covered call. So now you're short a put at the money, you're long an at the money call, and now you're short an out of the money call. So what that creates is a covered call on the synthetic position. So you're essentially capping your upside up to what your covered call is at, and you are taking all the downside of the stock. So let's look at the prospectus of TSLY to get a better understanding on what it actually does. So I took a screenshot of the trading strategy that TSLY uses or explains in the prospectus. So let's go over it. So here they say purchase call option contracts at the money. So that essentially means that the strike price is equal to the then current share price. So if it's trading at 280, you buy the 280 call. If it's trading at 350, you buy the 350 call. That's at the money. So then that means that if the stock of Tesla increases, these options will generate corresponding increases to the fund. That might be true, however, you have time decay, right? They don't explain that in here. So time decay essentially means the closer you come to expiration, the extrinsic value of the option goes down, right? So the more time there is from the expiration date, the more could happen, and therefore the options are worth more. So the expected target for maturity is 6 months to 1 year. So that means that when they buy an option right now in July, that would mean that the option would expire in about January or longer. So then they sell a put. So sell an at the money put on Tesla. So that means that the strike price is equal to the then current share price of Tesla. So same thing for the call. However, now you're selling a put. So if Tesla is trading at $280, you sell the 280 put. If it's trading at 350, you sell the 350 put. So the same for the expected target maturity, same 6 months to 1 year. So now I've highlighted the most important description, in my opinion, when it comes to selling a put option. Put option contract provide exposure to full extent of any share price losses experienced by Tesla. So what that means is you essentially are willing to buy the stock at the money. So if it's trading at $280 right now and you sell a put, that means that you're willing to buy it at $280 6 months from now, right? So if the share price goes to zero, that still means you have to buy the stock at $280. So that's what they mean by that. So you're essentially taking full risk of the stock. So that is something to keep in mind, and that is actually what stops most people from doing a trade like this. It's the collateral that you need. So for example, if you go short a put option, so the brokerage that you use will demand collateral. So this can either be done through a margin account or through a cash account. So you can only do this in a cash account if you have enough cash available in your brokerage account. So that's something to consider when you're doing this trade, and I think this is actually what stops most people from copying TSLY trading strategy, is the collateral that is used or the collateral that's needed to perform this trade. Because if you're doing it right now, you need 28,000 almost in cash or collateral to do one strategy like this. So then when they've bought an at-the-money call and they've sold an at-the-money put, they sell a covered call. So they sell a call. And this is an out-of-the-money call, usually 5 to 15% higher than the current share price of Tesla. So let's say it's trading at $280. So about 10%. So that means they are selling about the 310 call, right? So that's essentially what they do. And then same here, I highlighted a box that I think is really important. So they generate current income, however, they also limit some potential positive returns that the fund may have otherwise experienced. So that is also something that people don't like about covered calls, and that's why some people might say covered calls are not effective, because you're essentially capping your upside. So the max return this trade would get you is essentially 10-15%, and then including the premium you receive from selling the call option. So the expected target maturity is 1 month or less. So for this fund, it's actually really effective because Tesla is very volatile. So the implied volatility on Tesla is relatively high compared to the overall market. And therefore, the premium you can receive from selling options, especially shorter term options, can generate a very high return. So that's essentially the trade that they do. And I believe that you can actually replicate this pretty easily. Of course, this is not financial advice, but I do think that it's much better to actually do it yourself, because you can actually do this on any stock you like, right? So for example, now with YieldMax, you're essentially only exposed to 3 stocks. However, if you understand the strategy, you can do this on any stock you may like. For example, you can do this on NEO stock, on SoFi stock, but you could also do it on a stock like Procter & Gamble. So let me know in the comments if you found this video helpful at all, and like and subscribe, that would help me tremendously, and I hope I see you guys in my next video. Thank you so much for watching.